Sometimes I have to admit, I get a little excited when I start thinking about the benefits of real estate investing when it comes to taxes. Now, I'm not a CPA. I'm not a tax attorney. I have been investing in real estate for quite some time now, and I've been having these discussions. Today, I'm excited about our conversation with a CPA because we talk about these terms in a simple manner. And I want it to be just enough to start engaging your curiosity so that you can see that you should be placing priority on these things. Some of the key terms we're going to talk about is depreciation, straight line depreciation, accelerated depreciation, or bonus depreciation. Even in the manner of Section 179, I love that rule. And how about cost segregation? We're going to talk a little bit about that. We're going to talk about the difference between active depreciation and the passive, the way to leverage depreciation on your passive income too. And that's being a real estate professional. What does it take? What does it mean? And then finally, we talk about this thing called 1031 exchange. I love 1031 exchange. It enables us to leverage the power of the tax code to build generational wealth utilizing real estate. Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Today's guest is a tax expert in tax resolution and tax advisory services with a particular interest in real estate. Also, a senior instructor at Indiana State University teaching real estate finance and principles. Please welcome Ed Gallatin to the show. All right, Ed, welcome to the show. I appreciate your time. Where are you coming? Where are you at? Where are you coming to us from today?
Terre Haute, Indiana.
Terre Haute, Indiana.
And most
Very
people
nice.
are more familiar with Terre Haute, Indiana as Indiana State University and Larry Bird.
Oh, yeah. The Hoosiers. Yeah. Absolutely. And today on the show, first of all, thank you for your time today, Ed. You are coming to us, and a lot of the shows or episodes that we have here, I make a lot of disclosures that I'm not a certified public accountant. I'm not a tax attorney or anything like that. But today you do have three letters at the end of your name, and they are CPA. Tell us a little bit about your journey, how you became a certified public accountant, and what you're up to now, Ed.
Okay. Well, the reason I became a certified public accountant goes back, probably 30 years ago or so. My wife and I, we owned a restaurant up in Park County, Indiana. If you're familiar with Park County, that's the covered bridge capital of the world.
Cool.
And they have a huge festival up there every year for about 10 days. And a little county that has about a population of 30,000 gets 2 million visitors.
That's
so
great.
If you had a restaurant up there, you become rather busy and preoccupied. Well, what I did was that I didn't make daily deposits. And at the end of the festival, I deposited a huge sum of cash into the bank. And guess what? That triggered an audit.
Yeah.
And it just wasn't an ordinary audit. They were convinced that I was skimming money out of the restaurant. So they went and investigated the entire restaurant business. And since it was a sole proprietorship at that time, they said, well, we need to take a look at your personal records. Okay, we went through my personal records, and they going through that. They found out that I also had some business contacts with my father. We had joint ownership in a hardware store up there. And they just said, well, we need to audit him too. So after about 90 days of continuous back and forth furnishing documentation, it went silent. And of course, then at that point, I called some professionals, and they said, uh-oh, it went silent. Usually that's an indication it's going criminal. Oh my God, what's going on? And in about 6 months later, I got a letter from the IRS. course, I put it on the kitchen table and stared at it for about 2 hours before I opened it. Then I opened it up. No tax change. Absolutely clean audit.
What?
And, they put me through living hell for about 9 months.
Yeah.
I thought then and there, I'm going to go back to school, get my certification, and help people like small businesses that are having problems with the IRS. So basically, that's my niche in being a CPA. That's how I got into it. And my niche is a tax resolution, helping people through tax controversy with the IRS and tax advisory services, keeping you out of trouble and planning to minimize taxes. So that's kind of my backstory.
Very interesting, coming through via experience with this. And it's always entertaining too. And I'm sure you've come across this so many times, just the cost, especially if you start bringing in attorneys and, tracking back through the administrative time to go back through, track and pull. And, if there's any request for information, it is just mind blowing. And then at the end of it, which is good at the end of it, it was like this, but at the end of it, it's like, okay, never mind, you're good.
Yeah.
Where's the cost?
And thousands of dollars in attorney fees later.
Yes.
And of course, I picked up the tab on my dad because it wasn't his fault. So
right.
I covered his costs.
Yeah. Wow. So yeah, definitely fueling the fire to now help other people along the way. And I'm excited to jump in the conversation now because real estate. So this is the Real Estate Mogul MD podcast, and we work specifically with high income earners in a way to, I guess, make that change in their life and start investing in a way that's taking them closer to where they want to be. So first, we always talk about, Ed, that we need to know where we're at in order to know where we're going. And then the second question is, where are you going? What do you want to do and why? Why do you want to do that? Why do you want to be there? But everything that we do is going to be affected by the decisions that we make, especially in the tax world. And we have a lot of conversations about, being a W-2 earner, that writing these 6-figure checks every year for taxes, and finding ways to, I guess, be more efficient with what we're doing, because taxes and interests are the holes in our money bucket that seem to take the most away from us.
Oh, it's your most expensive expense.
Yeah. So we talk about real estate being one of those things, and you have an interest in real estate specifically. Tell us a little bit about your experience in real estate.
My interest started back with my grandfather. He owned several rental properties. And of course, I was a snot-nosed kid and I hung out with Grandpa. And I learned a lot from him, strategies and also repairs. My grandfather was rather portly. So anything that needed to be done under a house, little Eddie came in very handy. So I learned a lot about plumbing and sewage pipes and underwater and those kind of things, electrical, and that just kind of stuck with me. Throughout my life, I've had rental properties off and on. Right now, I don't have any residential rentals, but I do have some commercial rentals. I own the office building that I'm in, plus tenants. So anyway. And also, I didn't know if you noticed on when I sent you my little mini resume there. I also teach real estate courses at Indiana State University.
Yes, sir.
So I do real estate finance as well as I teach tax, of course.
Yeah.
But anyway, that's always kept me interested in real estate.
And when you say you teach at the university there, what are the main topics that you love to share when it comes to real estate?
Most generally just telling them the stories of my past. Obviously, we talk about the nuts and bolts of real estate and real estate law and those type of things. But a lot of them are really interested in real estate. And most of them, I don't know where you got your original interest in real estate, but all those TV shows on the on TV that they flip a house and make $500,000 in 3 days, and all the kids think that they can do that. And I said, well, maybe.
Yeah.
And I'm telling the stories. Of course, I flipped a few in my life, so I got some firsthand information on that. But and just give them some guidelines on, if you're going to be a flipper, you make your money going in, not coming out. So it's how you buy, and watching your cost, and figure before you make an offer, you got to figure in, what's it going to cost me to turn this piece of real estate, and factor that into your purchase price.
I heard a quote from a gentleman named Grant Cardone. He was on a podcast a while back, Bigger Pockets podcast. And he said, if you don't know how much money you're making the day you buy a property, then you shouldn't buy it. And the hard part of that is, Ed, is that it's not realized. So it's not realized until the exit, right? So It's difficult. But projecting the right expenses is massive, and surrounding yourself with the right people to understand that is really important too. We talk about that a lot. One of the things that we consider in this and why real estate is attractive are the depreciation currently in the current tax code. Like, this is always a moving target, right?
Correct.
It's not loopholes. It's not, black, white, and gray. There are ways for us to leverage the existing code to our advantage. And these particular instances or stipulations are laid out there because it benefits the area, the government, the workers, everybody, for us to own real estate and to improve real estate and provide these homes. So everybody should be leveraging the existing code to the best of their ability.
Absolutely.
So when we talk about this, Ed, what are some ways? So we've got, in my mind, I've got two buckets. I've got residential and commercial, and then we'll set aside the active versus passive regard. So in my mind, I'm breaking down this the depreciation world, the write-off world, into a couple buckets here. Is a commercial and residential. And then on either one of those, we've got the active versus passive. So in the commercial and residential world, we've got depreciation and we've got straight line depreciation. The time was at 27 and a half years for residential and
39 for commercial.
39 for commercial. So this is basically taking the value of the property minus the value of the land. Where does that come from anyway? How in the world do we say the land is worth this much, so I'm going to take that off there because it's not going to depreciate?
Correct. Well, definition of depreciation is just the allocation of the cost over the useful life of the asset. Now, where they come up with 27.5, I think that was probably a compromise in some committee in the House and Waste Committee. Right. How do you figure a 0.5 for a life?
Right.
That was probably some type of a compromise. And 39 years, that was probably a compromise. Why didn't I not pick 40 or 45 or 35 or an even number?
Right.
But anyway, how those numbers come up is irrelevant. What is critical, and what most real estate advisors or real estate investors, let me rephrase that, didn't realize, especially on commercial and even on residential. Are you familiar with cost segregation?
Absolutely, and I want to get into that in these two buckets here too.
Yeah, and that is so overlooked by so many investors. They'll go out and buy a office building, or they'll go out and buy maybe a strip mall or something along that line, and just and their accountants put it on a 39-year depreciation schedule. They're sets, and they're missing huge opportunities with cost segregation.
And right now, missing huge advantages because of this moving target that I was talking about. So if you have this opportunity in front of you in the existing code and you're not taking advantage of it, and then next year, 3 or 5 years down the road, that's gone, that's a loss of opportunity, and that's massive. So overlooking these things. So the value of the land versus the value of the structure itself, we take away the land, we depreciate it. It's just a go-to straight line. And when I'm looking at my projections, when I'm looking at holding a piece of real estate, I keep it simple. I just do straight line. I think the icing on the cake is when we can accelerate those and do different strategies like the cost segregation. So the cost segregation, Ed, is a way of looking at the structure and assessing the depreciation in different ways based on the structure itself.
Correct. Yeah. We take a building and we take a look at a building and what's in there that's really not going to last 39 and a half years. Well, we got carpets, air conditioning units, heating units, cabinets. I mean, there's a whole litany of things. Sometimes you buy it with furniture in there. And these are the kind of things that we can separate out and put on a separate depreciation schedule. And once it becomes personal property instead of real property, then we can kind of take a look at it with Section 179, bonus depreciation. I mean, I've seen people take as much as 30 to 40% of their purchase price and write it off in the first year, just by using cost segregation. I want to kind of forewarn people. Right now we're kind of in, like you said, a moving target. And this year, bonus depreciation has been reduced to 80% instead of 100%. And next year goes to 60, 40, and eventually phased out. Now, will it come back? I think it will, because the IRS, we've always had some type of bonus depreciation available. So I think legislation will come back to where it won't go to zero, but definitely we're not going to be on this roller coaster of 100%. That was great.
Yeah. How long was it like that, Ed?
I think the bonus went in 17 with the Tax Act under the Trump administration.
Okay. Yeah. Okay.
I believe
So definitely swinging on the color of the flag that's at the White House, on how all this comes down and just leveraging what's available for us again. So if you were unable to implement these strategies, or maybe you're listening to this and you just didn't know that you had those strategies available, you missed out, because like I would say, it's a moving target. And this cost seg thing is big. You mentioned the 179, the section 179. And in that, the thing I like about that, and utilize this myself too, is when my investment company owns a vehicle or purchase a vehicle, that you can, it's 6,000, I believe, 6,000 gross weight vehicle. You can go ahead and accelerate the depreciation on that vehicle as well too.
Yes, absolutely.
So just great ways. And now, at this time of the year where we've wrapped up 3 full quarters of the year, you need to really start looking at where you're at and things that you should be implementing, strategies in a proactive versus reactive scenario, implementing these like cost seg, like the section 179, those types of things to help you recoup or not pay as much in taxes, leveraging the existing code.
And another thing that you really need to take a look at is, can I qualify as a real estate professional? With and you got that 750 hour.
Yep.
Now I realize, you're a medical doctor, got to practice. How in the world can I take 14 or 15 hours a week and become a I keep saying a real estate professional. And the thing is, if you're married, why don't you let your wife be the professional? You file a joint return, right?
Yep.
And the beauty is, once you become a real estate professional, then you don't have to, you were talking about losses a while ago. And right now, because probably most of our viewers here make over $150,000, they say, well, big deal. I can only take $3,000 a year. Well, once you get that designation as a real estate professional, that goes away. And you can take those large losses and offset your W-2 income from your profits.
That's switching buckets there. When I talked earlier about the passive bucket and the active bucket.
Exactly.
When we qualify as a real estate professional, we call it the rep. It allows us to use our passive losses to offset our active income.
Yes, and that is overlooked by so many CPAs. Mm-hmm. I mean, you may take it to a CPA unless they're really in tune to real estate. They may very well miss that, and through no fault of their own. I mean, they're not totally incompetent. It just never gets brought up to their attention.
Before we left the cost seg idea, now cost seg can happen in either one of the first two buckets I talked about, right? It can happen in commercial and it can happen in residential.
Absolutely. You can do, yeah. And that's another one where they miss. They don't think about it. You go out and buy a $300,000 or $350,000 home. There's a lot of opportunity for cost seg in there.
Mm-hmm. Yep. So commercial or residential, running that cost seg. And then this cost segregation idea, it requires an engineer to do the analysis. Is that correct? Well,
it doesn't have to. I would recommend it. Mm-hmm. Only because if you ever are involved in an examination, they're going to be asking you questions on methodology. And just as a real estate investor, you might say the wrong thing. And might be able to and end up losing some of the deductions, where if you got an engineer that can actually explain the procedure, and generally it's smooth sailing.
Very good.
Generally, what most cost segs are around $2,000, $2,500. Money well spent.
Okay. And I guess there's probably no hypothetical, like we could break down, okay, how much am I actually able to depreciate, to accelerate on a cost seg if a property was worth $100,000? Ed, is there any way that we could break that down and say, what is a general range?
Well, you take out all the heating and cooling, wiring, if it has an elevator, obviously. About anything that's mechanical in the house would bid. On your carpeting. If it's a residential, the cabinetry, you could probably cost seg it out, because it's not going to last 27 and a half years. You're going to be replacing it. Absolutely all the what do you call it, appliances would be taken out. So I
mean, you could run to
maybe 30%.
Yeah, you could get it there at 20, 30K pretty quickly doing something like that on a smaller house. So, even the 30%. So just running a scenario, again, a hypothetical, if we've got the 100,000 in the taxable value minus the land, so we've got 100,000, and then we're able to accelerate the depreciation on 30% of that, we've got $30,000 then that we would be able to offset. So in staying in our passive bucket, I would have to have 30,000 of income in that passive bucket in order to offset. Is that correct?
Correct.
Okay. And then staying in this passive bucket, that 30,000, say I had 30,000 in rent coming in, I could completely offset that, not have to pay any taxes on that. So that 30,000, if you look at a pure cash value of this, if you're in a tax bracket, say 37%, does that sound reasonable?
Sure.
So at 30,000 times 0.37,
you would be your state tax, depending on what state you're in.
Yeah. So just generally speaking, simple 37% effective tax bracket, we'd be looking at approximately $11,000 that you would not be paying out. So you would be investing $2,000 if you paid the engineer to do this analysis, and you'd be keeping $11,000 of your money. So the ultimate net exchange there is well worth it.
Absolutely.
Very, very, very good stuff. So, and then we get the idea of passive versus active, and there are some other stipulations inside of this real estate professional classification that will reduce the number of hours and time required based on the type of property themselves, moving towards that short-term world, where we're making it a little easier. One of the challenges that we see across the board with physicians is that physicians are typically married to physicians. So they live their lives in hospitals and in school, and you're around other physicians so much. So oftentimes it's hard to pull that REP classification because of it's a family of physicians,
Correct. But one thing that a lot of people overlook is when you're calculating that 750 hours is it counts if you're just supervising others. So let's say you have contractors come in or subcontractors, as long as you're supervising them, those hours count.
So on the 750 level, it's not necessarily material participation, or does that supervision still cut the materials?
No, it counts as material participation.
Nice. Very good. Very good. All right. So we've talked about a couple buckets here: active, passive. We've talked about commercial and residential. I just see a massive path forward in real estate. And eventually, if you're not able to pull the REP flag, but somehow moving your investments into the passive, if all of your income was then coming into this passive bucket, now all of your depreciation can be affected and you don't have to be a real estate professional then.
That is correct. Yes, absolutely.
So that's very interesting. And then we talked about something. I had a conversation a few weeks ago about being a limited partner in a syndication and having the ability to basically stock up on depreciation, and then have the ability to use its depreciation either when we're cashed back out or whatever, so we could save this depreciation in our passive bucket.
Yeah.
So awesome ways to put this stuff together and really reap the benefits that are available out there to us. But you've got to surround yourself with the right people, right, Ed?
You got to have your team. That's right. And I'd say any real estate investor should have at least a three-man team at a minimum, and that would be your financial advisor or banker, the money man, an attorney, and a CPA. I'd say if you're going into real estate in a large way, that's absolutely necessary to have that team put together.
Do you have any other suggestion for the physicians out there that let's take it in a couple steps here? One, say the physicians who are listening that are just coming out of med school, maybe in residency. So somewhere early on in their earning capacity, right? So they've got a lot of debt going on and, just getting into almost stepping into this high earning time in their life. Do you have any suggestions when it comes down to tax for them?
Well, it depends on how, one, you got to have kind of a love for real estate business. But it doesn't take a lot of money to get involved in rentals. I mean, you don't have to be flipping, but just start gathering. Because while banks require 20% down, you're looking at houses, or at least in our area for rentals, around 50,000-60,000. So you don't need a large down payment. And again, you cost seg the thing out. That pays for your down payment. Then you start getting cash flow. And that's the whole key is cash flow. I mean, that's what you're in it for. And I'd say even, of course, they got a lot of time commitment. And that's one of the reasons I kind of got out of single family residential rentals. Well, I call it the PETA factor. I don't know whether you heard about it or not. PETA, pain in the ass.
Oh. Yeah.
Toilets only plug on Friday night.
Yep.
things along that line. So,
Yep. Yep.
yeah, the late night phone calls, this doesn't work, that doesn't work. Um, and that's the price you pay when you're starting out.
Mm-hmm.
Right now, like I said, I'm not in any residential investments, but I am looking. But what I'm looking for is something maybe a 12 or 14 unit residential units, apartment complexes.
Yep. Yep.
Problem is here in Terre Haute, Indiana, we have 4 colleges, which means there's a high demand. Where there's high demand, right now I think they're kind of priced out to where I wouldn't get the cash flow that I would really want.
Mm-hmm. Mm-hmm. Yeah, and that beginning part, obviously, I mean, that was where I cut my teeth, was self-management, was self-repairs, was all of that stuff. And that stress, the money paid, all of that sweat equity piece, we do look back now and we call it an education. So that time spent doing that, you learn so much, and you start limiting associations and expanding associations. You want to limit with those people who are not helping you or leading you astray, and then expand with the people who are like, if I came up and said, Ed, how do you have these rentals and you're not managing them? What are you doing? How can I do that? How can I learn? Right.
Yeah,
So
exactly.
expanding those kind of associations. And then, after, building that, I guess, capacity, stepping into the 14 units or the 20 units. And, now you've built up equity as well too. You can do 1031 exchanges. We haven't even talked on
discussed that yet, have we?
So let's talk about that one for sure. So, I heard a gentleman, say, depreciate, exchange, die. So can you elaborate on that just a little bit, Ed? What's your take on that?
Well, basically what you're doing is with a 1031, you take a piece of real estate property, you sell it, and normally you would have a capital gains, right? Or hopefully. Yeah. But instead of paying capital gains tax, what you do is take that money, reinvest in another piece of property, and we can roll that capital gains over into the new property. And what the IRS calls defer the capital gains. Well, what you do is you defer it, you pass away, your children inherit it, stepped up basis, they start over.
Depreciate, exchange, depreciate, die. And when that deferred capital gain tax happens, we all call it kicking the can down the road. And there's this same with Section 179. When you defer the depreciate, or when you defer your taxes, basically by depreciating an asset, you're kicking the can down the road. And we always get this thing, well, you're going to have to recoup that. You're going to have to recover that depreciation, right? Well, this depreciate, exchange, and then as a generational wealth building tool, that step up in basis allows us to not recapture any of that.
It goes away. It goes away.
Yep.
And then your children have the property to start over at fair market value.
Yep. So what a great way to, again, given the current tax code, what a great way then to build generational wealth in real estate, and do that to where if you're going to be passing money on, it's a great way to do it. So you're growing that, and it's the snowball effect of compounding interest. When you depreciate and then exchange, you're capturing that equity, and then you're not getting taxed on it and putting it into another investment. So how fast is that money growing? Much faster, exponentially.
Correct. Absolutely.
Yeah, that excites me. That whole idea of depreciate exchange excites me. So the 1031 exchange does require a specific team as well too. Ed, is that something that you guys do, is the 1031 exchange, or is that a niched kind of thing?
Well, that is kind of a niche. I got an attorney friend that we always use as a what do they call it? There's a term and it's escaping me, but you got to have the third party that holds the money.
like a custodian or something like that.
Yes, yeah, custodial account or whatever.
Right, right,
But you cannot do that yourself. So
right.
when you're what you do is you sell the property, you put that money into escrow, for lack of a
Yeah.
better word. I don't think that's what they call it on the 31 exchange. That term just escaping me right now. But anyway, then you have 45 days to locate another property. You don't have to buy it yet. You just have to give them a list of 3 properties that are potential targets. Then within 6 months, you got to actually close on one of the 3. And then basically you recalculate the basis in the new property and move on.
And that's amazing. So you leveraging those instances, and there's actually a way that you can do it the other way too, I believe, when you find the other property first.
Right. Yeah. It's called a reverse exchange, but
Yeah.
basically the same thing. And you're using a third party to hold the money, and it just.
So don't let the limiting belief set in your mind of, oh, that sounds too complicated. I don't have time for any of that. I don't have any of that. You have time exactly for what you put priority on.
Exactly.
And this is something that you should leverage given the situation, right? Like, so if I'm going to sell something, I'm going to make $10,000. I don't know that it's enough to go through the hoops on doing a 1031 exchange. That might be different for each person, depending on the cost and how the properties line up, right?
And you got to remember too, when you're selling a piece of property in real estate, you have this depreciation recapture that you got to keep in the back of your mind, and that's going to make a big difference on about the amount you really are saving on the exchange.
So the depreciation recapture is not the net ticket sale. So hypothetically, if I've held this property for 10 years and I'm only making 10,000, I've also depreciated that
exactly
$2,000, $5,000 a year for 10 years. That's another $20,000 in depreciation that I'm going to recapture. So that's a great point too on the 1031 exchange.
Yes.
Yeah. Beautiful. Beautiful. So many things to consider, so many things to keep straight, but at the same time, I also want to encourage everyone listening to this that don't let that be a limiting belief. Just because you're not comfortable with it now, find somebody who is. Find a way forward, and it needs to be priority, because this is one of those things, Ed, that allows us to leverage the existing code. They make it so complex, they make it so complicated, but they give us these little nuggets. And when we don't take advantage of these nuggets, what are we doing?
You're just leaving money on the table.
That's right. Leaving money on the table. I don't like leaving money on the table.
But neither do I.
Yeah. Awesome. Well, we've got this website here, Ed. It's HEG-taxrelief.com. So HEG-taxrelief.com. And that's your home spot. Like, I see that you've got somewhere on there. It's called Tax Tips. You do a lot of videos. Give a lot of value out there. And if somebody wanted to reach out to you, they could connect with you on there and talk more about taxes, right?
Not only that, I also have a tax library in there. If they want to research a subject,
Interesting.
you can go in there and pull it up, and they have several articles. Like if you want, okay, on the podcast, I remember it said something about a 1031. You could go to my website, go to the tax library, punch that in, and get a couple articles on.
Very, very interesting. Very cool. Yes, it's a very robust resource here. So that's on there. If you want to talk to Ed, otherwise known as Harry too, right? Harry?
That's right.
Yeah. So the HEG tax relief, we've got that resource there for you. Man, I get excited when I talk about this stuff. I appreciate you being on the show today, and thank you so much for your time today, Ed.
I'm pleased you invited me.
Awesome.
To be here.
All the way from Terre Haute, which is close to this Park County you were talking about, right? The covered bridge capital of the world with 2 million visitors a year. That's very interesting. So my real estate ear hears that and it's like, oh, Airbnb, what's going on there?
There you go.
Yeah.
And remember, that festival is only 10 days. So if you rent out your property for under 14 days, that's rent free or tax free. I mean,
Yep. Awesome. That's awesome. All righty, sir. Well, thank you again for your time today. I really appreciate it.
All righty. I appreciate you having me. Thank you.
All right. And the listeners out there today, that's just a little tax nugget information dropping there. I've been bouncing around these ideas for, I don't know, the last 7 to 10 years. So I can engage in the conversation, but I don't want that to overwhelm you in being able to engage in these big key pieces. Some of the big key pieces are the 1031 exchange, the real estate professional classification, depreciation, cost segregation. These are the things that you really that you don't need to know, but need to know the name of, so you can start having these conversations with wonderful people like Ed and other people around, other investors who are implementing these strategies. Because like we said, this is what we're given by the code. And if we don't take advantage of it, then what are we doing? This is the stuff that is laid out there for us to benefit from. So get around people that do know the ins and outs of this, build your team, like Ed was saying, have the right people around you, and take advantage of it. Don't hold that limiting mindset that you can't do this, you don't have time, you don't understand, you're not an accountant. I'm not an accountant, I'm not a tax attorney, I'm not any of that. But I get to have wonderful conversations here with wonderful people like Ed, and we just make it work. So thank you for your time today. If you have any questions for me, info@physicianwealthsystems.com, and I'll catch you on the next episode. Thank you so much for listening.